hear me, it means you can also respond in the YouTube poll here, which we've got, which is which of these ETFs will do best in 2023? Is it A, VAS, B, IVV, C, GOLD, otherwise known as gold, or D, NQ? I've got a bit of feedback here. Is it one of those four? Which one is it? If you want to say why in the chat, that will help. It looks like VAS, aka the Australian share market, is off to early lead. Of course, my name's Owen Rask, founder of Rask Group, and you guys know me because I'm here every week and I'm having a bit of fun with y'all talking about investing. It's always a bit of fun in reporting season because there's stuff to talk about, and it's not just the same mill of news and things that are coming out. But one of the things that happened this week, and I don't know about you guys, but I was quite surprised, is not just the increase in interest rates. So that's kind of expected, but it was what came with the increase in interest rates, which was this, I guess, commentary that you can expect, this is the RBA speaking, you can expect increases, meaning plural, increases in interest rates. So I think that spooked a lot of people, and you can see the stock market goes like this and then it just drops straight off the face, which is pretty scary for a lot of folks. So I get that, and we'll talk about that tonight. As always, joined by Rob behind the keyboard. G'day, Jason. G'day, Mike. G'day, Mwanda. Benny, everyone. Paul. Always a bit of fun to have you guys with us. But I can see here, I really want the answer to be NDQ, says Rob, but I don't. But I know it won't. Why do you know NDQ, the Nasdaq 100 ETF, Rob? Why do you know it won't work out? Please let me know. Pilbara, says Mike. Is it Pilbara or Pilbara? I still don't know. Cameron says NDQ tech stocks have performed well in the last decade and significantly outdone the market in terms of gains. They got sold off heavy. Time to bounce back. Cameron, I like it. I like that. You wrapped a thesis around that comment. I love it. It's a lot of what the RBA says as much as what it does. Yeah, Cooper, I agree. And my theory, says Rob, my own theory is that the US is meant to have a bit more trouble. Interesting, Rob. Interesting. Trouble meaning economic trouble, I'm guessing. Okay. Adrian, you've said of the four, you're on LinkedIn, and you said IVV, since it comes off 25% since its highs, QQQ, which is an ETF, is already showing signs of a reversal. Okay, cool. Rob, you said you're betting on ASX 200. Interesting. Okay, interesting. Anyway, tonight we're going to be talking about a few different things. We're going to try and jump around. I'm going to try and move through things as usual. I've gone, we want to do this much, and then I've looked at the clock and the clock has said, but you only have this much time. So we're going to try and fit in as much as we can. We did have some questions and some ideas sent in advance on Twitter in particular to say, hey, can we talk about this thing? And one of the things that was sent through, which I'm about to show you, is really important, I think. I think for me, it's the number one decision that I'm thinking about. And Rob goes without saying, it's not financial advice. When you say you can go forever, well, maybe, maybe I probably can. I can keep talking. So apologies. I'll try and keep us on track tonight. Okay, I'll share my screen and then we'll get into it. But as always, let's start with a little bit of a friendly joke here. We go, what do you call a factory that makes okay products? Satisfactory. That is my dad joke for this week. And not much of a dad joke. It's not an investing joke, but I mean, we talked about factories last week, didn't we? When we talked about laser bond, that's my only connection. I was just searching through this list of dad jokes, 136 dad jokes. I was like, it's going to be one that's related to finance. And I got to about 50 and I'm like, I'll just take that one. That will do. So Martin says, oh dear. Yes. The joke was deemed satisfactory. I don't think so, Jason. I feel like that one fell on deaf ears. But okay. So if you haven't already subscribed to Selfwealth Live, please do us a favor. We get very sad. I had to hold Rob the other day because he realized we weren't at 9,000 subscribers yet. And yeah, that was a hard day for both of us when we caught up. So please, if you haven't already and you like the show, please subscribe. It does. It's like we don't have a KPI, but it's kind of like a KPI for us because we like that. We like to measure and make sure we're doing the right thing. As Rob said in the chat, anything that we do mention tonight is limited to general financial information only. Here's a photo of me in Hosier Lane in Victoria. I was looking slightly younger, and that was only a year ago. What will bear markets do to you? You know, so yeah. Anything that I mentioned tonight is strictly limited to general financial information only because I don't know your personal circumstances. Even if I do attempt to answer a question, you can learn more about Rask at www.rask.com.au/FSG. And yeah, if you are confused about anything, please seek the advice of a licensed financial professional, aka financial planner. Okay, so Umbrella Lemming, Gary, you give me a 6.5 out of 10 for effort. So I'm thinking the 6.5 is for effort because I don't think the joke was that great. I was the first person I want to say your name correctly. I guess it may be, if I'm not mistaken, Eoin. Owen is the Irish spelling for my name, which is English. So maybe that's how I know. We have a 2-hour show on our hands, Chef Circle. Indeed, indeed. Okay, so I got this question sent through in advance. I just put out a bit of a tweet normally every week. You can follow _ Selfwealth on Twitter if you do like the Elon Musk platform. Also available on all the channels, including TikTok and Instagram, wherever you get your social media, Facebook as well. One of the questions that come through was, I said, what do you want me to talk about? And the question was bonds. Why didn't they hold up better in 2022? Why are they still low? Are they close to being a buy? Are bond ETFs okay, or just stick to index ETFs? I'm going to explain all of that. I'm going to do it in a couple minutes because I think it's really important. Then we're going to get into some money hacks really quickly, and then we're going to dive into 5 companies. Remember, please share your comments with me, particularly with this first section around bonds. We're just diving straight in the deep end. James Bond being one of my favorite movies. It's not what we're talking about, unfortunately. We're going to be talking about bonds on the stock market. And inside an ETF is probably, in my opinion, one of the best ways to invest in the bond market. So what are bonds? Bonds are often called debt. It's often called fixed interest as a whole. And basically the idea is you get an income stream. It's called a coupon, which is like a dividend. Just think of a dividend as a coupon. But instead of the bond going up in price, it has a fixed price of, say, $100. And the way it works is, for example, let's say the government, the Australian government wants to get money to build a new MCG. And they think we're going to own this infrastructure asset where we need bonds, we need to issue bonds, we need to get some bonds out and people can give us money. And it's like an IOU. So the government comes to me and it says, hey, Owen, we need $100 from you because we want to fund this project that we're working on. And I go, okay, no worries. I want my $100 back in 10 years, but I also want it back with 3% in interest or a coupon payment of $3 a year. Now, that's a bond, right? And you can sell that on the market. That's all it is. But the only bit of complexity comes in really when you think of this. Bonds tend to go the opposite way of interest rates. So the government bonds that I'm talking about tend to go the opposite way. And an illustration of this is inside this bond ETF, there are many different bonds, not just one, and not just of the same length or duration. There are many. And if we look over 10 years, well, maybe we'll go 5 years. 10 years, 5 years, they both show the same thing. You guys will remember that interest rates started going up, right, about a year ago. So you can see that as that happened, the bond fell in price. So as Chef Circle just said, bond rates are still going up, bonds going down. Now, what you might notice here, Chef Circle, is this was January 2022, right? And it had started to fall before that. So why did it start to fall before that? It's because people expected interest rates to go up. So when someone is expecting something to happen, they can sell down now to avoid that pain. And that's what we kind of saw there. Now, what happens is an ETF invests in bonds because it's probably the best way for you and I to go and invest in the bond or the bond market overall. Because what happens is sometimes these bonds are worth $1 million and we have to buy them in $1 million parcels. You can buy individual bonds. They're called XTBs and they are available on the ASX. XTBs, they're called individual bonds where they're broken up. But for the most part, ETFs are the easiest way to just get a whole heap of them in one go. But what happens is, I want you to imagine like a snake that's eating its food. Eventually, the snake passes through all of that stuff that it's just eaten, and it comes out the back end, right? And the same thing happens with an ETF, being the snake in this instance. The snake or the ETF collects the bonds, and then eventually those bonds mature and new bonds go into that ETF. So over time, the bond ETF gets newer bonds and they're refreshed and the old ones go out. And that's important because what happens is, as interest rates go up, the new bonds that come in start to yield more. Now you can see this portfolio has also fallen here, and I can explain that if you need me to. But for the most part, what happens here is that over time, a bond portfolio will start to be yielding more, which is good. It will start to be a better investment. And we're starting to see that now. Not only are interest rates, according to some people, at a point where they're expected to be near their high, like people aren't really expecting interest rates to go to 10%. There may be, worst case, 4 or 5%. Now, that could change, of course, it could go higher, but that's kind of the expected worst case. So if that's as high as they're going to go at 3.5 or so percent, we're nearly there. So people are starting to think, well, maybe now it's time to start looking at bonds. For our core portfolios at the Rask business, what we do, I did not suggest snake feces to be used as a bond ETF analogy, but I like it. Yeah. Well, it's human nature, mate. I don't know. It's animal kingdom, Eve. It's a bit of animal spirits here every week, let's be honest. So for the most part, bonds should be in a portfolio. So bonds should be in a portfolio. Jaden, you've asked a question: how low would one go on the bond rating scale with bond ETFs when investing? So Jaden, what happens is there are different types of bonds. So I'll just see if I've got the fixed interest. I'm just going to bring this up. Fixed interest. I think I showed this last year, default table. Credit default table. I'll just bring this up. It just shows you something interesting, right? Because people often ask, well, you can give like the government your money and it's pretty safe, right? So these tables here, remember there are different ratings, as you alluded to, Jaden. And so what happens is there are different ratings of bonds, right from like the best bonds, AAA rated, right down if you've seen like the Big Short or something like that. But what happens is as you go further down the quality of a bond, what happens is you end up getting more yield. You're getting more like dividend, if you think about it like that. You're getting more of that. But in turn, you're taking much more risk. And so for most of the big bond ETFs, to answer your question specifically, Jaden, you typically see them as government bond ETFs. So they're kind of like they're what we call investment grade. They're really high quality. But there are some different types of strategies where I think an ETF is not appropriate. And so that's if we go further down into those riskier bonds. So like credit, high yield credit, those are things where you probably want an active fund manager to make decisions. I had a really good interview with someone recently. I think we spoke about this with Drew actually, when he was on the show recently. It's called Senior Secured Loans. And this is just, what's this? Rask. Yeah, so I had Invesco on one of our podcasts recently. I'm just going to bring this up really quickly. And this is just a podcast that I did with one of their team members. And we spoke about senior secured loans. It's with Ashley here. And in that's a type of bond that's further down. It's further down the credit. So it's right down the bottom here. It doesn't even have a rating, typically. So Sparky, you've asked a question. Is a bond ETF, is it like A200 or VAS purchase and set and forget for the next 5 to 10 years in a portfolio? Yeah, so that's the general idea, Sparky, is that now I'll bring my screen, my camera back up. So what's supposed to happen, and to the question that we received via Twitter, what's supposed to happen is that when stocks keep going up, bonds are not supposed to keep going up. Bonds are supposed to just kind of just like hold their own. But then when stocks fall, bonds are supposed to go up. And the general gist is this. Normally when the stock market's going up, what tends to happen is interest rates slowly fall over time. So that would, drive modest increases in bond prices. But then as interest rates go up, bond prices fall, right? So bond ETFs fall. But then when we have a recession, interest rates fall because the government's like, holy crap, we need to lower these interest rates and let everyone pay off their mortgages quicker and have more money. And then the bonds go up and the stocks fall. So that's kind of what we're seeing at the moment is bonds should start to resume some normal cruising altitude, whereas stocks are falling. And we haven't really had this for a while where it's been a normal market because interest rates have been so low. But for me personally, my approach going forward is to have around 10% allocated to bonds or fixed interest. In my high growth portfolio, a retiree might have nearly 50%. There might be other mixes in there. It's not all in one ETF. It's not all in Australian bonds, those types of things, but it's diversified. But you get the picture. Traditionally, in olden times, bonds were all you had. So I don't actually know if the yield curve is still inverted, Chef Circle. That's another discussion. Again, Cameron says, other than interest rates, what else macro would affect bond prices? A whole heap, Cameron. So some things like geopolitical risk, currencies are one of the big indicators for bond prices, because the bond market is, I can't remember the latest number, but the bond market is so much bigger than the stock market. It's not even like, you can't even compare it. It's so much bigger. So what happens is when the flow of money goes from one country to another, has a profound impact on interest rates, on foreign exchange, because all the money's flowing to where there's higher interest rates. So say, for example, we've seen the US dollar appreciate, or if you look at the Australian dollar, it's fallen. The US dollar has got more valuable. The reason is everyone's trying to buy into US bonds and they're pushing their money back into the United States because interest rates are all of a sudden looking good over there. So that pushes down our currency. So there's all different types of macro effects. But if I could maybe single out some of them, obviously you've got economic things like inflation, because that is normally, if inflation is high, it tells you interest rates might go up, like we're having here in Australia. And currencies are probably the two big ones. And then there's a heap of other things. But those are the two big ones that I would call out. Jaden, you said, thanks. I own some VAF, which I believe is around AA minus. Yeah, you can check the credit ratings by going to the ETF providers' websites. There's some things that you would want to look for when you look at ETFs for bonds. You want to look at how big is the bond ETF. And this is important because you just want to understand the liquidity. It has to be easily trading the bonds. So the one that I showed on the screen before seems to be quite liquid. So does VBond, which is one of the biggest ones. This is my new preferred exposure. This is another alternative. VAF is international. Whenever you invest in international fixed interest, you want to make sure, or you want to just strongly consider that it might be a hedged ETF. That just means that the currency is neutralized. So that's probably the big one there. I recently bought more bonds for my portfolio, and I instructed our members to do the same. And not, when I say more, I don't mean they went and put all of their money in bonds, just a little bit to start that gradual process away from cash and back into bonds. Because I think the conditions are slowly firming up. Like, it would be the smart decision. And this is, I think, the biggest decision that every investor with a meaningful amount of money, even if it's 100 grand, 200 grand, $10 million, this is the key question that people are asking themselves, at least in my circles, in professional circles. How much do I want in bonds now? This is the question. And a lot of people that I speak to have already started to make the move. But then you see everything in the news and you just get scared. So, Jacob, you said, do you have any views on options trading in addition to bonds/equities? Jacob, that's a great question. I will answer it quickly. The bonds thing is very confusing, guys. You'll see that I got some terms flipped around the other way. But just think this. Bonds should be part of a diversified portfolio, definitely. You can invest in cash if you just prefer something that you know and understand. And there are a few impacts on bond prices. There's some great reading from Vanguard and BlackRock and all the others. So just in terms of options trading, Jacob, so it gets quite complicated, obviously, but Mike says options trading is a ripoff. So personally, I was watching the 2022 Berkshire Hathaway, Warren Buffett, Charlie Munger meeting the other day, and they spent about half an hour, it seems like, without catching breath, just saying how more and more the stock market just seems like one big crazy casino. And all you've got to do is keep it simple to make money. And I would agree with that sentiment. And I paraphrase there. because I think we get more and more exotic with our investing. The more complexity we add, it's like an order of magnitude, pardon me, more stressful. But I also think that I haven't seen the proof in the pudding. So all the professional investors that I interview from right around Australia, if not the world, most of them that go down that path of getting more complexity in the investing strategy eventually unwind it. Hasn't the stock market always been a casino for trading? Yes, it has, I would say, Owen. But that said, we haven't had a lot of the, as Charlie Munger would say, computers trading against computers. So we haven't had a lot of the automated trading, which can, is basically free for people to do and can put like super sophisticated strategies. And it basically is just placing trades against another computer that's trying to do exactly the same thing. And the trading frequency just goes way up. Whereas in the past, you had to call your broker, you say, hey, I can have $100 of this. And they'd be like, oh, I'll see if I can get you some. So if you're interested in this stuff, Jacob, go and check out Jim Simon's Renaissance Technologies. If you are interested in trying that line of thinking, go and Google Jim Simon's. I think the book is The Man Who Cracked Wall Street. He used to be an ex-CIA code cracker. Since I discovered Jim Simons, I realized that I could never trade as well as Jim Simons. And I will never, ever try to trade as well as Jim Simons. And I will prefer the safe haven of Warren Buffett and index funds. Caroline, I was actually going to put this in the chat. 1 second. Please don't switch off and go and watch Warren Buffett for the next hour because you can't be bothered listening to me. I'll bring this up on the screen. But CNBC did it this year. Last year it was Yahoo Finance. Warren Buffett, Berkshire meeting 2022. So I live about an hour from the city, so I just jump on this and I just watch snippets of this every time I'm driving to and from the city. There you go. So that I just sent through the link then to the CNBC thing. It's 6 hours. It's just like I can't think of anything that I would happily sit there and just watch for 6 hours. I cannot do it with anything else. But you get me, Charlie Munger and Warren Buffett, I am there, and I'm doing it. It's just such a good watch. So anyway, let's get back to my slides. So let's just quickly sum this up. Why didn't they do better in 2022? Well, interest rates went up, so bond prices went down. Why are they still low? Because that's the way bonds are. It takes many years for the new bonds to float through. But when interest rates start to plateau, they'll probably start to go up. Are they close to being a buy? I've slowly started to tip some of my portfolio, just a small amount of my portfolio, slowly tip it in. Are bond ETFs okay? I think for government bonds, yes. And because remember, just a very important point here. Some people do mix up the language here that an index fund can also be a bond index fund or a property index fund. The word index fund just means it follows an index. So we think of VAS and A200 and IOZ and STW like the share market indices or index funds, but they can be anything. So bond index funds are bigger, I believe, than share market index funds. I could be wrong. 6 hours, there's a new benchmark for Selfwealth. Okay, I'm going to get into these money hacks real quick. So we just wanted to try something out a bit different. Well, I wanted to try something out a bit different. Many of you will know that I spend a lot of my time investing. It's what I do. It's my job. I'm an analyst. But actually, like the Rask community, some of our most popular ideas and topics and podcasts that we do across our network are actually not pure investing. They're more like personal finance or property or cash flow management. And I just wanted to cover some of these really quickly. We got an email sent through to us the other day, not too long ago, actually. And I mentioned this at our event not too long ago, that we just had this very simple thing. Someone was talking about refinancing because they were worried about property and mortgage and interest rates going up and all that sort of stuff. And they just called their bank and they managed to get 1.5% off, which I've never seen. I've never seen someone get that much off just from a phone call, but that's about $5,500 a year saved just from making the phone call. And the reason I'm bringing this up now, guys, obviously is because interest rates are going up and a lot of Aussie households are going to feel the pinch of everything. So you can either earn more to try and keep pace with inflation, or you can cut your spending. And there are some really simple ways that you can do both of those things. I remember the best financial advice joke I've ever come across is earn more. That's how funny we are as people that are in the finance profession. But the first thing is get a better rate. You don't need to refinance to get a better rate from your bank. A lot of people know this on the show already because they either have paid off their mortgage or what have you. So I won't spend too long there. Some people, it still amazes me, still have credit cards and they pay interest even though they're investing. And that just really boggles my mathematical mind, because I was looking before, if you could get a 24% insert bank name special platinum card and it charges 24% and the stock market's returning on average 9%, well, you're going backwards at a very rapid clip. You're far better off paying off your credit card and moving on. And we're seeing a lot of the buy now, pay laters. I think Phil Muscatello was on the Twitter messages and called out one of the buy now, pay later companies. They're all going broke because buy now, pay later is not actually a real thing. And it's gonna, the profit margins on those businesses are so slim, and during a credit crunch, it's just probably not going to work out for many of them. Side hustles. I don't know about you guys. Owen, you said I'm in the middle of 1 and 2, so getting rid of that credit card, fan-bloody-tastic, and getting a better rate. Already do 4 groceries. I didn't know this. The whole shop at night thing, I didn't realize that was such a big deal, but apparently it's one of the best ways to save money on groceries because you get all the things that are like on sale or going out or whatever. Never doing 3 side hustles, too busy, fair enough. I actually pay a lot of side hustlers. I was thinking about this. I pay to get my IKEA put together. Don't get me wrong. Like I come from a family of trades and renovated my own house recently. But IKEA furniture, I am not doing that. And so I pay air taskers to come do my IKEA, and they get a couple $100, and it's brilliant for me because I can go and do other stuff that I really want to do. And it's just this new economy, the modern economy, where you can switch on for a couple of hours, make a bit more money. And the final thing is really interesting. So this is something that I always believed to be true, but in investing and in economics, we have this idea like of a utility curve, and we have this idea of utilization. And so don't grocery shop when you are hungry, Martin. End up buying too much rubbish. Yeah, I agree with that. Never shop at the convenience store would be the other one, because the convenience is a killer. But when I think it was the second or third ever interview I ever did on our Australian Investors podcast, I spoke to this guy called Tony Hansen. He's a really interesting fellow. He's very unique in how he lives his life and how he goes about investing. He actually, so this really interesting. So, Tony runs this, he's a fund manager, and he runs this investment fund which doesn't charge management fees. To an extent, it doesn't charge management fees. It just charges performance fees. So you only pay him if he performs well, and that's a really hard thing to do. But Tony's a really frugal guy, so he started the fund just investing his own money, and he thought, well, I'm doing it for myself. I could do it for other people, and if I do well, maybe they share a little bit of that with me. But I'll just keep doing it. And he has these really interesting ways to save and make money. And one of the things which I wanted to call out right here is he and his wife and his family did this thing where they would buy used cars at auction. And he would buy cars like, Suzuki Swifts or Toyota Corollas, just normal cars. And they'd be just around that period where, they've been used by like a fleet company or by a church or a school or a big business. And they would go to the auctions and get sold for dirt cheap, below their market value. He would buy them, drive them for 2 years, and then sell them, I believe, for a little bit more than he paid for it. Now, what the big insight is this one. And if I've got it here, he goes, I would estimate this activity of buying those cars, selling them for break even, this activity has added in excess of $300,000 to our family worth, given the money was invested at returns averaging about 15% or so over the past 15 years. So he's basically made this he's basically made this trade-off and said that, you know what, depreciation of what we buy is the silent killer of the middle class in Australia. And I believe that to be true. A lot of people buy things that aren't assets and they think they're assets. So things like cars are a classic one. They've gone up recently, but they're a great way to cut costs out of your lifestyle. RBT Cat, you said stop buying monkey JPEGs. Yeah, so that's the NFT craze, right? So that's another good one. But anyway, those are my money saving tips. I think we've got about 835 billion of them on the Rask websites, and the rest of the team are so much better at them than I am. So you can go and check that if you want to find out more about how to save money. But I live a very frugal life anyway, to the extent that I did a two-page Excel spreadsheet comparing cars and their depreciation, and also running scenarios depending on the economic environment and whether they would depreciate faster or slower. And then at the end of it, I just decided not to get a car. And that was the best outcome for me. So that's basically it. So yeah. And I think the best value for me was a Kia. It was the Kia that was 5 years old. That's the one that I estimated caused the least damage to my family's budget. So I'll just put I'll put the link to Tony's article in the chat. Tony's article. The podcast embedding didn't work, but it's a bit outdated. But you can still find the podcast online if you just Google Tony Hansen podcast. Okay, so we've got some blue chips we're going to sink our teeth into. And I just want to see really quickly, did we all vote? So it looks like, yeah, we all voted. So which of these ETFs will do best in 2023? And by far, the consensus was Vanguard VAS at 54%, followed by NASDAQ, then IVV, then gold. Interesting. So that's interesting. I would have, to be honest, I would probably have gone with, I couldn't vote because I was the one who did the poll. But if I was to vote, I would have said NDQ, so the NASDAQ 100. So Rob, you're welcome. Because tech stocks have been so badly punished. And many of those companies are still brilliant companies in the NASDAQ 100, the NDQ ETF. I probably would have thought those, but also, or even IVV. But it's interesting that we're all so different in what we choose. So yeah, it's just great. It's good to see. Great. You're welcome, Rob. Okay, here we go. So we've got some blue chips. Last time we talked about small caps. Last week we dived into small caps and we talked about these different businesses. Most of them are still yet to report their formal results, so we can go back over them when they come out. SmartPay is a bit different because of its a slightly different reporting season calendar, but they're all still kind of in the works. This week, I thought we'd go back to basics a little bit and look at some different companies and go maybe from left to right. These are all very different businesses. So in the first instance, and I'll jump into Selfwealth here, you will remember this if you watched Selfwealth Live last year. We talked about BWP Trust. This is actually not a company, hence the name Trust. It was talked about, I believe, if you all could correct me if I'm wrong, but I believe it was talked about in the Barefoot Investor books. And this trust is pretty simple. It just owns the properties that Bunnings Warehouses are found. So it just owns those properties. Bunnings pays the rent to BWP Trust, and that's the business model. They also do like Harvey Norman's and general purpose retail and stuff like that as well. Slightly different business. Many of you will know Macquarie Group, otherwise known as Silver Donuts because of its logo, which actually the Macquarie, this is really interesting. So some people will know what I'm about to do and what I'm about to say, but the Macquarie Group logo is meant to be two coins, right? It's meant to be two coins. It's meant to show a big coin around the outside and something punched out of the middle. And the actual logo, it actually gets its origins from, I believe, when we moved away. This is maybe not specifically correct on the exact reason for this, but the reason Macquarie has this logo is that when Australia moved away from the gold standard, we had to import coins. right? We had to import coins to have some currency, and we didn't have enough coins to go around. So what they did is they just punched a hole in the big coin and made a small coin. So then you had two different coins. So they created two currencies from one, or like one with two different coins from one coin. And that's why they have that logo. And I just joke, it looks like a silver donut. So I probably shouldn't be insulting the heritage of that. But that's the basic idea. The Macquarie Group is Australia's biggest investment bank. It's one of the biggest in the world. I think it's in the top 20 in the world. So that means it's not like a typical bank where you would go and get a mortgage, even though that's what they're trying to focus on now. You do a lot of other things like commodities trading. I think they're one of the biggest green infrastructure owners or managers in the world. So meaning like wind farms, hydroelectric dams, those types of things. It's a huge business, massive business for Macquarie. The last one here is Pinnacle Investment Mangement. So PNI is the ticker symbol. And the thing is, people get blown away when I show them this. It's one of the best performing companies over the past 10 years. So you can see way back here, it was 37 cents, pardon me. Now it's up around 10. It did get up to around $18. So what does Pinnacle do? Pinnacle, it's not the gyms, if you know the gyms. It's Pinnacle is one of these businesses that if I was going to start one, it is what I would want to start. So typically what happens in a funds management business, like a fund manager like Magellan or some of those other big brands which you give your money to the fund manager invests it for you, and they earn performance fees, and then they'll earn management fees. So it's a really good business for them, because if they're good investors and they make money for you, they also make a bucket load for themselves. What Pinnacle did is Pinnacle realized that the key risk in that is if you're not going to be a good investor for a very long time, all of your clients are going to leave and you're left with nothing. So what they did is they said, well, we're not going to be the investment manager. We're not necessarily going to manage all the money, but what we'll do is we'll take an ownership slice in many of the different businesses, which they call affiliates. We're going to own a small amount or a large amount in all of these other fund managers who are really good, and we'll supply them with marketing. We'll help them, grow their sales team and their sales pipeline, find clients. We'll run events for them. We'll manage all of their admin. And so all the good investors can just get back to running their investment portfolio. And so basically what they have is like the kind of the best of both worlds. They have many of these different investors that can invest, and they make share in the upside of their success. So that's what Pinnacle Investment Mangement do. And I'll show you on the screen. I think I've got the Prezzo up. I don't have the presentation, so I will just quickly look inside my Selfwealth account. If I go news and announcements, here we go. So let's have a look at the Prezzo here. That's technical language. That's what we analysts call a presentation, a Prezzo. So here we go down. And here we go. So here we can see, I'll get rid of this thing and we'll zoom in a bit. So this shows you here across all of the affiliates, so across all of their different partners that they own some of, how much are they investing? And we can see here that Pinnacle has been growing a very, very long way. It's interesting that the share price chart roughly tracks FUM. Yeah. So what happens is, Owen, and this is a good point you bring up. So if we look at this chart through time, Pinnacle makes money in two ways, ultimately two ways. It has to make money from the performance fees. So that's if their investors do better than the market, then they collect a fee for doing so well, and also management fees. Management fees, just like an ETF, is dependent on how much money they manage. So if you can see here, this chart, the columns show you how much money is invested across their network. So 83.2 billion is up the top here. But you can see that's fallen recently since the stock market has hit its high, right? And that you would expect that because, the stock market's been pretty brutal. So the important thing here that you can also see is these dark parts of the column, what they show you is institutional money. So the institutional money is this dark, it looks like a dark blue or some sort of dark green. And the like this, I guess this peachy color is this pinky color is the retail fund. So what that means is, if you and I went and invested in a Pinnacle Investment Management, if you and I went and invested in one of their funds, we would be classed as retail because we're not Australian Super, who is an institution. But the difference is we can't negotiate fees. But if Australian Super approach them, they could. And so what happens is, in a chart like the one that we just saw, I'll just show you who they are quickly. In a chart like the one we just saw, where are you? Where did you go? Oh, where did you put it? Here we go. This pinky colored part of the business is actually what's really valuable. Giving me some Magellan head noise, Cameron. Yeah. Well, this is the difference, right? So I actually think Magellan's a great business. It's had a very rough time and they've got so big, right? It's what it is. But if we look here, the difference is that Pinnacle has a small part or a large part in each of these different businesses. So it's kind of like if you were collecting all of the different fund managers, collecting all of them and putting them under one roof. So that means if one of them goes down, you've still got another 20 or so that can still hold the fort, so to speak. And so that's why the business has been pretty resilient. Even though one fund manager might have its time in the sun and then another one doesn't, over time, you do that enough and you get good at it, you can keep growing and growing and growing. And they're not the only ones. There are others in Australia, like Benelong, that do it. Then there are some other fund managers that do it. But over time, they've realized how profitable fund managers can be, and they've collected all of these businesses on the way. While we're on the topic of Pinnacle, the problem has always been that Pinnacle shares are very expensive to buy. So you've basically got to kind of like, unless you're doing like a full discounted cash flow analysis, which is quite hard because you have to predict each of the different kind of businesses underneath the surface. You kind of just have to accept that it's going to be a very volatile investment and that the business is, I guess, at the whims of what happens in the stock market. But the basic idea, as long as they do their job, as long as their individual investors or their affiliates continue to impress their clients, they're going to make a lot of money. So, Owen, you said the sad thing for Magellan is that Chris is nearly Hamish's equal, but everyone just focuses on the headline news. Mind you, Chris liquidated a heap of funds to cash in 2020. I'm not 100% sure. I noticed your question mark there, Owen. I can't remember if he did or he didn't. Maybe. I can't remember exactly. But remember, Chris is still very heavily aligned through the MFF leak. Owen, I don't know if you saw that when we covered that session on Selfwealth Live, but he's still very heavily aligned with this. This is a listed investment company, so it's slightly different structure. But yeah, no, don't need to worry about sidetracking me, mate. I sidetrack myself. So at the end of the day, if you look at the business's performance through time, it is incredibly profitable. He was buying a heap of MFF, says Martin. Yeah, super profitable business because it's really, if you look at its profit and loss, all it really needs to do is just make sure its affiliates, i.e. these fund managers, are provided with marketing and they're finding new clients. And then they can take care of the rest. So you can see here, half year 2023, it had $23 million of revenue and expenses were $21 million. But they also get a share of the profit. So there's $28 million. We come all the way down and it's a really profitable business down here. If that doesn't make any sense to you, let's go to the cash flow statement. So here we can see, now maybe I can take a moment. I've got time. I'll explain this. Would you invest in Pinnacle or buy their shares? So that's a good poll for the group. For me, I would buy their shares at the right price, Owen. I would buy their shares at the right price. Absolutely. I've just got to find the right price. About 6 or 7 years ago, I passed up on the opportunity to invest. I didn't want to. I thought it was too expensive. And then it went up about 6 or 7 times. So joke's on me. Anyway, the key thing to watch with Pinnacle is its cash flow. So this thing right here, this is the key thing because this actually kind of smooths out some of the experience. And the key thing is, like, over time, this is the cash that actually goes to Pinnacle. One of the things that happens, and I think I've got time to explain this really quickly, is if a company owns too much of another company, what happens is, or not enough, I should say, if it has an investment in another company, the accounting gets really funny. It doesn't just show up as sales or revenue on the company that owns the other company. It actually shows up in the balance sheet. And depending on the balance sheet, it depends on whether that can be recognized as profit or loss. That's why in Pinnacle's results, it's a bit weird, because you've got like revenue costs, like costs, expenses, and then you've got profit. But then there's this big item just stuck in here that says like share of profits from affiliates. And that can be very volatile because it depends on whatever the balance sheet is showing. It's a kind of a complicated thing, but yeah, I'll probably won't be able to have time to go into it in too much detail. It's called equity accounting. But that's why I focus on the cash flow with Pinnacle. Okay, I'm moving very slow. So would I buy Pinnacle shares? Yes, I would, but probably not right now. I'm starting to get tempted, put it that way. I'm starting to get tempted. I think it's a really interesting business. There's aligned management at the helm. And by the way, this table here, guys, I've kind of got sidetracked tonight, is just the table that the checklist that we always follow. It's the Warren Buffett checklist on the show. Circle of competence, aligned management, competitive advantage. Is the company growing? Does it have a reasonable valuation? I was just going to do an overview and I got stuck in the weeds, but I could maybe fill this in for myself really quickly without explaining too much of it. But circle of competence, for me, out of 10, it's probably a 9 or a 10. I would even maybe give Pinnacle a 10 out of 10 for me, because I understand how fund managers work just as well as anyone else. Is management aligned? Yeah, they own a heap of stock. Same gent has been in charge the whole time, basically. Is competitive advantage? Not really, because it's like, yes, it does have a competitive advantage, but active fund managers can struggle from time to time. Is it growing? Yes. Is it a reasonable valuation? It's getting there, so I'll give it a 5. And just to illustrate, if this is your first Selfwealth live session, I just try and encourage you guys to have like a process that you can follow and you can repeat again and again. So then you can benchmark companies and you can do all of that. Now, if I was to do the same from Macquarie, I'd say it's aligned, but not as aligned, because it's a mothership and wonderful management team. I'll maybe give it a 7, but it's just like they call it the millionaire's factory for a reason. I haven't done a valuation of Macquarie, and in fact, I don't really trust anyone who comes up with a valuation that's very specific for Macquarie, because Macquarie's business is so complicated. I don't know how anyone can value it specifically. So you can have a general sense of value, evaluation, but I don't know how anyone could hand over heart say, I think it's worth exactly this, because it's got investment banking, it's got asset management, it's got commodities business, it's got mortgages. It's one of the most, there are variations of management across Macquarie because it's just so big. Yeah, absolutely. I think the CEO is terrific at Macquarie. The business, it previously was run by Nicholas Moore, who was, I think, the highest paid banker in the country for like forever. But yeah, they pay really well, but they also have so many good business lines. They're great in technology. They have one of the best wealth management platforms ever. Seriously impressive business. You just got to pay up for it. And just look at the financials over time. Get rid of this, and I'll go down to profits or net income. Start with that. And look at that. This is, if we had a chart that went back a little while, what it would show is that in the GFC, Macquarie got absolutely smoked. It got absolutely poleaxed. It almost, like, it maybe didn't go out of business, but it was so bad how bad it got for Macquarie during the GFC, because this is a time when all the investment banks were going broke. But Macquarie bounced back in a massive way. So I'll just bring up, why don't I just do this screen for a bit? Just go back to what it was originally. So Macquarie is a super impressive business. Would I buy the shares? I'd buy them at the right price. I don't have the price right on me right now. Let's see what analysts are forecasting. The analyst price targets, according to Selfwealth, are around $200 a share. You guys know that I just mentioned these. I do my own valuations, but yeah. So RBT Cat, last time we had risk in the small caps checklist. So last week we talked about risk in a general sense, negative from 0 to -10, and that would deduct away from the company's score or quality. Yeah, so what I was just trying to do is bring in something different here. So RBT Cat, this is a really interesting thing. So when we talk about small caps, obviously because of the Rask license to give advice and talk about investing, we have to be very cautious when we talk about small companies. But as a general rule, as someone who started my own business and runs my own business today, the way I think about risk is quite different to what a lot of investors think about. Because a lot of investors, when they think about a company's risk, they think about, I don't know, what's an example? They would take Alcidion, which is that small cap we talked about last week, and they would see this and be like, that's extremely risky. Look at the share price. It's gone up, it's gone down, it's gone, who knows what's going on. I don't see that as a risk. What I see as risk is I see this as risk. I see what's happened to companies like BrainChip, and I think of that as risk because now they might look the same in a share price chart, but I think of business risk, right? That's my definition of risk. And for me, the way I capture that risk, I guess, assessment of a business, when I look at a company, is I look at the business itself. And to Owen's point, look through volatility. So this is a long and totally useless way of saying that I think the risk metric is captured in the competitive advantage for me. So if I have a business that has a very strong competitive advantage, by definition, it should be a lower risk business. So this is how I kind of capture it in this particular checklist. Like if it had a 2, then it would be much more risky because it doesn't really have a competitive advantage. It might be in my circle of competence, it might have an aligned management, but if it's got a 2 for competitive advantage, it tells you that I think competition's really strong. Whereas if we just look at these two side by side right here, I would say that Macquarie is a less risky business compared to Pinnacle. But I couldn't put Macquarie in the same checklist as this one because Macquarie would be 10 out of 10s compared to all of those companies just because of its nature. So when I do these things, I kind of mix it up for the different types of investing that we're doing. So I'm just going to spend a couple more minutes just quickly talking about these last two businesses, and then I'll introduce you to them, and then I'll try and give you the things that you should watch out for before you go and do your further research. But this company, I don't know if many of you will own it. Credit Corp Group is a really fascinating company, and it's the best at what it does in the country. There is no question about that now. It's also a massive business in the United States. Like Macquarie, Credit Corp was absolutely smoked during the GFC. To give you a sense, let's have a look at them if we can go back to the maximum chart. So during the GFC, Credit Corp fell from $12.30 a share to 64 cents. $12.40 to 64 cents. Macquarie Group, it was about 120 to 30, was it? I don't know. It was about $90, nearly got up to 90, 87, down to about 20. So I think both of these businesses can be volatile, but Macquarie's definitely learned from its ways. Now, what does Credit Corp do? Credit Corp is what we call a receivables management company. So let's say, for example, you've got an outstanding debt to Telstra, and Telstra is trying to collect that debt from you, and you don't pick up their calls. You just block everything. You never pay the bill. Well, Telstra could say, well, Greg from down the road, Greg's got $100 of debt outstanding. And then they go to Credit Corp, and Credit Corp says, well, I'll take that. I'll buy that debt from you. I'll give you $5 and you sell the debt to me. And then Credit Corp takes that, having spent $5 on this PDL, that's what they call it, PDL, purchase debt ledger. And then they go and try and recoup $20 from them, say, for example. And if they can get the $20 back from you, then they've made a profit of $15, right? Because they spent $5, got it, and got 20 back. And that's basically this business. It's called receivables management, or as it was formerly known, debt collection. So debt collection is basically what it is. And so if we come into the financials for Credit Corp, it has been an outstanding performing company. One of the ASX's best, you would have to say. A truly excellent business. While one of its competitors, Collection House, went bankrupt. So it has done extremely well. It's expanded overseas, and it's just continued to grow through like sensible long-term management. The business during that time, I don't, Mike, if your question was related to dividends, but it's been extremely consistent. So if we come down here, it's been extremely consistent. Get rid of that. And Macquarie, if that's who you are also referring to, Mike, has also been extremely consistent. Macquarie has recorded a profit, I think, for 53 years in a row. I don't know of many businesses that have done that, maybe except for Washington H. Soul Pattinson, which has paid a dividend for forever, it seems. Cochlear has been very profitable for a very long time too. But these are kind of like these super companies. If you remember back to that conversation we had with Nathan Bell from Intelligent Investor a few months ago, he believed that there are really only 10 to 20 great companies on the ASX, like 10 to 20 truly great companies. You would have to say Credit Corp is probably in that 10 to 20. It would probably be in that 10 to 20, just based on how well the business has performed. It's growing, well managed, it's profitable, pays a dividend, does everything that you would want. So just in general, you reckon, Mike? So how do I rate dividends? So dividends are great if they're consistent. For example, with BWP Trust, which is the Bunnings Warehouse Trust, this is incredible. It's an incredibly reliable dividend payer. Look at that, just flat the whole time. It may as well be a bond. Incredibly like sustainable, or not sustainable, but incredibly like reliable dividend payer. So over time, yes, I highly rate dividends. In fact, Mike, I guess the gut feel that I have, and I think Scott Phillips talked about this on the show when he came on last year. Speaking of Nathan and Scott, two great educators in the investment space. So as he articulated, I think from memory, he said something like 4 out of every $10 you get out of the stock market is in dividends. 4 out of every $10 you get. So people that just look at the share prices, they're missing $4 out of the 10 that they could be getting if they don't pay attention. So the idea is that, you take those dividends and you reinvest them. So absolutely. And when I see a company like BWP or a trust like BWP, that's my primary method of getting a return from the company, is that dividend or distribution over time. Finally, this is a company that I know the least of all these companies by far, Cettire. Does luxury brands, so like Gucci and that type of stuff. We'll have a quick look online, see what we can buy, see if you guys want to buy me a Gucci handbag or something like this. But you can see here the business is very simple, like kind of e-commerce business. Let's see what they've got in the way of shoes for us. Let's have a look. There we go. Let's see what we've got in shoes. I'm on a kind of binge this year. I'm on a break this year where I am refusing to buy any brand new clothes other than for work, of course, because I just wanted to try and just see if I could go a whole year without that. Cameron, you said, I sold out of CTT when the owner sold off a ton. Oh, yeah, I do remember that. Would love to know more of your thoughts on founder-led business, escrow and small caps, alignment of management. Chef Circle says, Gucci shoes from AliExpress. I mean, look at this. Like, $50, well, there's $1,100 for heels. Maybe they're like really good heels. I don't know. This thing looks like something you use in the shower, and that's $637. Anyway, I'm going completely off track here, but I don't understand it. This is my 6th money saving hack for tonight. If you want to save money, don't go to this website. So that would be my extra one. But Cettire is an e-commerce business, and to answer your question, Owen, I think that for the most part, if a manager says one thing and does another, if they blatantly come out and say, we are not looking at selling, and then 2 weeks later they sell, that is a huge, huge, huge red flag. If you can't trust the management team of a company, you cannot trust your modeling as an investor. You cannot trust your expectations. Now, I will add one caveat there. A lot of people see a management team, like a CEO or a board of directors, do one bad thing, and they think, nah, that's it, I'm out. And then 5 years later, they look at the stock price and it's up 5 times. And the reality is, every day there are decisions made inside every business. And not all of those would be good decisions, and not at any one time they might be not looking good or bad. So I don't just necessarily say one bad thing is a sign and then sell it. Like I think a lot of people have this idea of red flags. Oh, management have sold out. That's a red flag. It might be a red flag, but it might be an amber or orange flag. And I have a lot of those in the way I think about investing, Owen. I don't necessarily have any hard or fast rules. So I don't go if this, then that, so to speak. But when I look at a company like Cettire, the number one, or the two things that I look at, and I'll see if I've got the actual cash flow statement here. I do not have it here. It will be, where are we? I cannot see it. Is this it? It's a bit hard to tell, isn't it? I'll see if I've got it in the investor prezzo. But the thing that I look for, so balance sheet, no, don't want that. Don't want that. The number one thing that I like to look for when I look at these companies is I actually look at the profit and loss statement. I see how much they're spending on marketing, because a lot of these online businesses have to spend a huge amount on Google and Facebook ads and TikTok and all this sort of stuff to remain relevant. And if you think about that, as a business model, you don't want to be dependent on another business completely for your success. So I often compare the marketing spend and the profitability. I compare that to industry peers and what I think is reasonable. There are so many times that I've been stung holding companies where the company spends so much more on marketing than it does even ever making profit. And that happens a lot. That happens with a lot of online companies. So I'll just answer some real quick questions here. In terms of founder-led, yeah, so I kind of answered your question, Cameron, about founder-led. You said you sold out. Last week I mentioned how, Cameron, my challenge to you would be to go and to listen to that podcast that I mentioned last week with Wayne Hooper. There it is with some bad spelling. Go and check out the Wayne Hooper interview with Laserbond, and then have a think about how important it is for you to have a CEO that is aligned and thinks like a long-term manager and takes pride in the business. Thanks for a great session, Rob. Have a wonderful night, mate. I don't know what you're up to, but it sounds like you're going to go do something fun. So enjoy that, mate, and leave us all here to talk about investing. So we've just got a couple more minutes. We've got to do our giveaway as always. So management are absolutely critical. I'm of the opinion, Cameron, nowadays that I just would never invest in a company unless the CEO is top quality. I just wouldn't. Not because I'm a long-term investor of 5 or 10 years. I'm not interested in wasting any time with anyone that I have any question marks over. Why would I? There are 2,400 companies on the ASX. Reporting season, yeah, maybe that's where Chef Circle. Maybe that's where Rob's gone. Maybe he's going to have a chat about reporting season with some mates over some drinks. Who knows? Okay, so let's do this. You guys know what time it is. Top 5 most bought and most sold. Remember, all you've got to do is tell me which share or ETF, we're doing both tonight, Eve, in case you asked the question, which share or ETF is the most bought and which one is the most sold. If you guess both correctly, you can send an email to marketing@selfwealth.com.au and the marketing team at Selfwealth will sort you out. And what do you win? Well, you get my value investor program valued at $500. Normally it's $500, but you get it for free if you guess both correctly. Now, I've got a good feeling about tonight. Eve, yes, I do know you well. You do ask the question every week. So all you've got to do, Iron Man, you've said bought Megaport MP1. So while you guys get your guesses into the chat, just chuck them in the chat. If you can say like buy this, sold that, then I know which one you're talking about, because that generally helps. And I'll give you a couple of minutes just to get your guesses in. But MP1, you said. MP1, what's Megaport up to these days? Yeah, right. Investor briefing, half-year results. When's that happening? So Megaport, I think, did we bring up Megaport last week? So they're releasing their results on the 9th of February. That's tomorrow. Megaport's coming out with results tomorrow. They've been punished, if I'm not mistaken. Yeah. What about NextDC? NextDC is the one that I always compare it to because they're both Bevan Slattery companies. Bevan Slattery being the great Australian tech entrepreneur. Not quite as bad. There are some Halifax. I have it on here. How's my famed Apple going? There was a question that come through about Apple and Google, and I still love my Apple shares. I think Apple's a great business. Okay. Oh, Sparky, it had a downgrade, says Megaport. Downgrade of earnings. I didn't know that. Okay. Well, wouldn't be surprised, to be honest. Okay, so we've got some guesses in. Mike says he's copying Eve. What did Eve guess, though? I get why you're copying Eve. Right, okay, I get you. Vanessa says, sold Pilbara, most bought VAS. Mal says, sold GMG, bought VAS. Get your guesses in, guys. Get your guesses in. Can I give you a hint? I think I can give you a hint. Where are my notes? I think I can give you a hint. Let's just say it's reasonably obvious. I'll say that much. I've got my notes up here in a separate tab so you can't see it. Let's just say it's reasonably obvious. Reasonably obvious. That's what I'll say. Okay, get it in. You also get some free trades with Selfwealth, of course, when you guess correctly. I'll give you another few seconds because you're a bit behind me. Paul said LKE for both. How is LKE doing? This is Lake Resources. One great investor once said to me that I firmly believe the best thing anyone can do. He said, I firmly believe it's far more important to avoid things that don't go well than to invest in the things that do go well. That was what he said. And one of the ways you can I think you can scratch off a lot of mistakes is completely avoiding companies when they're on the way up, like big hype. Like they're really getting pumped up. And it looks like Lake could almost fall into that category because Paul, as you said, they've dropped. I think every week on the show, Lake Resources was in the top 5 in 2022, but now not so much. Okay, so all bets are in. All bets are in. That's my comment, and we're getting into it. At number 5, we have number 5 on the most bought list, BHP, big Aussie, big Australian, may operate in the Pilbara. We're not 100% sure. Being here in Victoria, we're not 100% sure. Maybe it's the Pilbara. Don't know. Just going by what I've heard online. In at number 4, we've got VGS, the Vanguard MSCI International Shares ETF. This is the ETF. If you want to invest in everything in the world, this is the one. So VGS, it's the most popular. In at number 3 on the most bought list, we've got Pilbara, otherwise known as Pilbara, depending on which part of the world you're from. In at number 2, we have VDHG. Remember, this is the basket of baskets. If you invest in this ETF, you get other, not ETFs, but you get other, think of them like ETFs inside. You basically get all your bonds, you get all your shares, all in one. You just make one investment, and that's what it's designed to do. I'm not saying that's right for everyone, but that's what it's designed to do. 90% in growth assets and 10% in defensive assets. That's why it's so popular. In at number 1 on the most bought list, I think a few of you guessed this, is VAS, Vanguard Australian Shares. That's the ASX 300. The ASX 300. So in reverse order, we've got 5 is VAS, 5 is BHP, 4 is VGS, 3 is Pilbara, 2 is VDHG, and 1 is Vanguard VAS. Let's move to the most sold. For those of you that are still in the game, congratulations. We have Fortescue at number 5, Twiggy Forrest's company. We've got Vanguard VAS as the 4th most sold. In at number 3, we have Flight Centre, Graham Screw Turner's company. Flight Centre, it's like ubiquitous for travel in Australia, especially amongst the older generation. We have number 2, Core Lithium. I think there was a guess around this. Core Lithium is number 2. That means number 1 is Pilbara Minerals. So if you guess Pilbara for sold and buy was Vanguard VAS and PLS, you are on the money. You have won some free trades. All you've got to do is email marketing@selfwealth.com.au and just insert a screenshot showing you're logged into YouTube so we can prove it was you. Congratulations. Winners, winners, winners. Got it, Jenny, finally. Well, congratulations to everyone, Jenny, including you. Congratulations, because you get some free trades through Selfwealth, but you also get to learn a lot more about investing if that's what you want to do through the Value Investor Program, which is, I would say, the most comprehensive investing curriculum in Australia. And you can get that on the Rask website. I took a lot of pride in doing that. It took me over a year to kind of piece that all together, but we got there finally. So well done to everyone. Well done, well done, well done. I do actually have one final slide for you. Oh, yes, here. This one. To loop back around from investing back into savings and good money hygiene. If you're smart, you're going to make a lot of money without borrowing. That's from Warren Buffett. It wouldn't be a Selfwealth Live if I didn't mention Warren Buffett at least 100 times. So that's my quote. If you're smart, you're going to make a lot of money without borrowing. And this is important in 2023. If the economy gets volatile and interest rates are high, you do not want to be stuck investing in companies with lots of debt. The question that came through. But you also don't want to have a lot of debt in your personal life as well, or in your business if you run your own business like I do. Avoid it. Times like now is when you should avoid it. So, Jason, you've said, Owen, can Paul have my prize from last week for that course? Well, Jason, that is a very, very generous thing. If Paul is willing to take that from you, Jason, absolutely, absolutely. Thank you for your generosity. All you've got to do, Paul, is email us and say, Jason gave me the Value Investor Program, or email Selfwealth, marketing@selfwealth.com.au, and they can email me if they're confused, but just say, Paul, you were a winner, thanks to Jason, and we'll get you sorted in that. So thank you. Thank you, everyone. We tried to cover a bit tonight. Next week, we've actually got an expert guest on talking about self-managed super funds for 20 minutes. We've got Tim joining us. Tim will talk about self-managed super funds, how to set one up, how much they cost, how to close one, how to manage one, what you can invest in, what you can't invest in. We're going to pepper in with a bunch of questions in about 20 to 25 minutes. And then we're going to talk about the actual companies. I do want to go a bit deeper on companies because it's been a while since we've done that. We focused on passive income over Christmas. Maybe once reporting season's done, we'll go really deep into a couple of companies. So maybe I'll get you guys to vote, probably on social media, on Selfwealth social media, and we'll go really deep into a couple of companies. Because if you guys remember, I'm just going to try and bring this up on the spot. 1 second. I'll see if I've got my Selfwealth. I'll see if it's in here. I'm just going to try and find something, guys. 1 second. I'm going to try and find something which is our portfolio, as you may remember, from last year. Because, is it this one? I think it's this one. Remember how we were doing these last year and we kind of just fell off the bandwagon because we got so many guests on and whatever? Well, if we look at the portfolio, if we look at the list of companies that we covered last year, looks like SmartPay is off to a cracker, up 76%. Catapult is not having a good one. Okta's been smoked. Promedicus is up 64%. And this is pretty good for a bear market when things are doing pretty poorly. What have we got in our low tofu portfolio, the sustainable, more balanced option with lower risk positions? We can see that we've got some bad ones like ARB, it was overvalued probably. Hack, which is a hack ETF, focuses on cybersecurity. Not a bad mix. I'm going to say it's not a bad mix. So remember, these are all the companies and ETFs that we talked about last year. I got you guys to volunteer one or what have you. We got some guests to bring someone to the show. Even the bond ETF's up 2.whatever%. I don't know what the ASX. I don't know if that's the right figures, but anyway, low tofu speaks volumes for its name. That's correct. That's correct. So I really want to get back to diving deep into these case studies. So we'll do that soon. But thank you everyone for joining us tonight. Hope you have a wonderful rest of your week. Remember that investing, if investing was easy, everyone would do it. And we're in kind of a volatile time right now. But as I said, I think it was last week on the show, I'm going on the offensive in 2023. The email is marketing@selfwealth.com.au, Paul. So I'm going on the offensive in 2023. I want to buy great companies because it's not always the case that you get to buy great companies or great investments for reasonable prices. And typically when you do is when everyone else is scared. So that's what I'm going to do. That's right for me, not necessarily for everyone else. Yeah, don't forget to send proof of the YouTube account there, Paul. Thanks, Jason, and thank you, very generous, Jason, for giving that to Paul. So I hope you benefit from it, Paul. I think you will. Wonderful. All right, bye for now, guys. Don't forget, we'll see you next week. Selfwealth Live, same time as always. YouTube, subscribe.